Hi class, welcome to lesson 1. Today we're going to start off by talking about the impact that your charitable giving can have and will have inside of your retirement finances. So to open that conversation, I want to remind you of the example of Lucy with her $100 that we talked about, a traditional donation versus a qualified charitable distribution donation. Do you remember that story? Well, if you remember, Lucy initially ended up with $5 after she had paid her taxes and her contribution or her donation in the first example. And in the second example, using a QCD, she ended up with $20. Well, when you apply this strategy to your own retirement finances, the beneficial outcome is usually much more than just $15 extra in your pocket. In fact, after auditing hundreds of households from the ages of 70 to 90, we found that the average tax savings per family was about $1,600 per year, with on the low end savings starting at $400 a year and on the high end as much as $5,600 a year. Remember, these are actual dollars that would have otherwise been sent to the IRS that now are sitting inside of their bank account. Let's use the information that you already have gathered throughout this class inside of your tax story worksheet to determine how much of an impact each of these charitable giving strategies might have on your tax savings. To do that, I want to introduce you to a new form called Brighter Giving Impact Worksheet, where we're going to walk through in this lesson each of these 3 charitable giving strategies: a qualified charitable distribution, in-kind distribution, and a donor advised fund, and how much of an impact they might make inside of your taxes. You ready to go there? Okay. You can see up on the screen, this is an example of the Brighter Giving Impact Worksheet. As you scroll down, you'll be able to see the QCD, the in-kind, and the donor advised fund. We're going to start off with a qualified charitable distribution. This top section has only 3 lines because to understand the benefit from a qualified charitable distribution is pretty simple. In this first line, we're going to add the total amount of annual charitable contributions. In this example, I've inserted $10,000 as a total amount of donations to your church through a tithe or a fast, donations to a mission fund, any hospitals, Boys and Girls Club, anything that is to a qualified charity. On that second line, you'll see your effective marginal rate. If you want to go to your tax story worksheet, part B, and pull out what your marginal effective rate is and put it in that line. I have an example of 27% here. You can see that $10,000 times 27% is $2,700, meaning for this family, if they do a qualified charitable distribution for their contributions into their RMD years, remember you have to be over the age of 70 and a half, they'll effectively have a tax savings benefit of $2,700. Why is that? If you recall, from our QCD example, this $10,000 that would have gone directly into their retirement finances and been taxed is now completely excluded from their taxable income. Let's continue on down the Brighter Giving Impact Worksheet to the in-kind donation section. You'll see as an in-kind donation, there's a few more lines because a few more things are happening to determine the benefit or impact from these charitable contributions. So let's dig into it. Assuming still on that first line, a current value of your donations, so assume $10,000 of appreciated assets that you're going to donate to a charity. And let's assume that your cost basis was half. So you'd paid $5,000 for this asset, whether that's a stock or any sort of appreciated asset. Then over a period of time, that $5,000 had grown to $10,000. So that's what your cost basis is. If you don't know what your cost basis is, you can ask your broker or your advisor or have your custodian run a cost basis report to determine your appreciated assets and what the cost basis is. So that's where you'd find that number. It's the initial amount that you paid for that asset. So if you minus that out, that totals your appreciated value. So in this example, 10,000 minus 5,000 is 5,000. And taking it on to the next section, we'll take that same appreciated value and timesing that by your long-term capital gains rate. Now, the most general rate is 15%. So 15% times 5,000 is $750. So this is the long-term capital gains tax that you are permanently avoiding by using an in-kind donation to make that charitable contribution. So the total impact or savings, tax savings that you're having is that total $750. All right, let's continue down the worksheet to the donor advised funds section. This is where it gets a little bit more complicated, but we're trying to simplify this for you so you can see the living benefit here. We're going to start out on the first line showing you the donor advised fund donation. This donation is $50,000, and I put that amount there on purpose. Typically for a donor advised fund donation to make a lot of sense, a higher amount is usually recommended. There's several donor advised fund custodians that start off at a minimum of $50,000, and there are smaller minimums, but if you're trying to reduce quite a bit of a higher income, usually the higher donation amounts are recommendable. The second line here is adding all other itemized donations. So for example, in this tax year, as you donate through a donor advised fund, let's say you have some charitable contributions, you have some SALT taxes, so state and local taxes that you're also paying that are itemizable. And then in addition to all of those, you have a donor advised fund donation. That's why we're taking all of your itemized donations or deductions and adding the donor advised fund on top to give us the full amount of itemized deduction in that tax year. You follow me? All right, $50,000 is your donation to a donor advised fund. $15,000 is your other itemized deductions that you were already going to put on your tax return for that year. That comes to a total of $65,000, which is your total itemized deductions. The next step is to minus out what your standard or itemized deduction would have been otherwise. Because in this calculation, we're trying to determine how much of a benefit this donor advised fund donation is, right? So that's why we're minusing out your itemized or standard deduction, whichever is greater without the DAF. So if you are already going to take your $27,000 standard deduction, we're going to minus that out of that because you would have got that tax benefit anyway. So that leads to this $38,000, which is your additional itemized deduction that you're getting from your donor advised fund. Now that is the amount that you're saving in your effective marginal rate. And again, you can pull that from Part B of your tax story. So we're going to pull that same 27% in, and that's your 22% federal and 5% state. And we're going to times that by that 38,000. So that gives you your annual tax savings of $10,260. So if you're making a decision on taxable benefit and you're trying to reduce the long-term impact of your taxes by donating $50,000 into your donor advised fund, you're saving $10,000 this year in taxes and freeing up that full $50,000 for the future to donate to charities when and where you please. There you have it. There's how to work through the Brighter Giving Impact Worksheet. I hope that you've taken the time to go through each one of these strategies that apply to you and figure out for yourself how much you and your household can save by implementing one of these strategies. Inside of our course promise, which is understand, see, and act, this is the action part. This is how you see and act upon some of these charitable giving strategies and hopefully find some confidence in moving forward because you can now see the impact that they'll have on your retirement finances. Wonderful. We will see you in the next lesson to talk a few more details about the step-by-step on how you execute that. See you soon.